Vietnam's dong, which is well known to be the country's national currency, is amongst the world's worst performers. If we were to graph out the exchange rate of the dong to the US dollar over time, we get to see just how poorly the dong has performed. Back in 1986, the dong was trading at a rate of 22.94 to the US dollar. That basically means you can buy $1 for nearly 23 Vietnamese dong. But as of 2023, you would need over 23,782 Vietnamese dong to buy $1, which is an increase of nearly 100,000% over nearly 4 decades. This same scenario of a weakening Vietnamese dong that played out in history is still being continued to play out today. If we were to check the performance of the dong in the US dollar for 2024, and as of the latest months available for 2025, we get to see that the dong had continued to depreciate in value. As of the latest data available, the dong had a rate of 25,520 to a dollar, which is a further decrease as compared to 2023. This depreciating dong has caught many people by storm. They question the impacts of this depreciating dong to the overall economy of Vietnam. Wouldn't it cause an economic crisis? Well, there's a lot of reasons why the dong is so weak, and why it may continue to do so. But there's actually a good reason why it's okay. But before we talk about the argument for having a weaker dong, we must first talk about how the Vietnamese dong got to be this weak in the first place. The dong's value, over time, is related to the inflation rate of Vietnam. During the 1980s, we saw in the earlier graph how the dong had increased in value during that decade. What we didn't know yet is during those years, the inflation rate was insanely high in Vietnam. Here's a graph on the inflation rate of Vietnam during the late 1980s. Here, you can see that Vietnam's inflation rate wasn't just any inflation, it was hyperinflation. For 1988, inflation rose to over 266%, which meant that the dong's purchasing power was being eroded. Following this crisis, Vietnam launched the Doi Moi reforms in 1986, shifting toward a market-oriented economy. As part of these reforms, the State Bank of Vietnam repeatedly devalued the dong to tame inflation and unify exchange rates. Throughout the late 1980s and early 1990s, the dong was devalued sharply, which alongside tighter fiscal policies helped bring inflation down from triple digits to single digits by 1993. For example, if we were to graph out the Vietnamese dong to the US dollar again, we get to see that the value of the dong saw a devaluation, from 22.94 in 1986 to over 4,501 in 1989, and to over 11,202 in 1992. It was thanks to these measures of devaluation that led to the inflation rate of Vietnam to decline. But why does a country need to devalue their currency to fix their inflation rate to begin with? Well, it's because of the relationship between currency valuation and inflation. When a country's currency is too strong, its exports become more expensive for foreign buyers, reducing demand for its goods and services. On the other hand, imports become cheaper, leading to a trade imbalance where more money flows out than in. This imbalance can put pressure on domestic industries, slowing down economic growth and leading to deflationary risks. For instance, if we were to graph out the exports of goods and services as a percentage of GDP of Vietnam, which show how much Vietnam's economy relies on trade, we get to see that in the 1980s, when the dong was still being fixed, the exports of Vietnam were very small. In 1988, 2 years after the Doi Moi reforms, exports as a percentage of GDP was only 3.9%. But as we extend this graph to include later years, the exports of Vietnam surged. In the late 1990s, when Vietnam's dong had depreciated massively, the exports of Vietnam had grown significantly. So, to put it in simpler explanation, the weaker dong has helped push the overall exports of Vietnam. But we will dive into that later on. For now, let's continue to talk about the reason why the dong had slid in value every single year. In the 1990s, the dong had continued to depreciate, partly because of the 1997 Asian financial crisis. The dong didn't really see a collapse like the Thai baht and the Indonesian rupiah, but at that time, the dong was actually pegged to the US dollar. If we were to graph out the exchange rate of the dong again to the US dollar, we get to see that in the 1990s, the rate of exchange was constant and didn't really increase or decrease from this level. After the 1997 year, however, you can see that the State Bank of Vietnam had to give up this peg, which in turn caused the dong to depreciate in value once more. This devaluation, however, has actually helped Vietnam maintain export competitiveness amid regional turmoil. If we were to graph out the export growth of goods and services of the Southeast and East Asian economies in 1998, which was the year that saw a big impact of the Asian financial crisis, we get to see just how much exports had grown in Vietnam. This was, again, partly because of the falling value of dong, which, as compared to currencies like Japan or Singapore, didn't really see the devaluation that was seen in developing economies. By the 21st century, Vietnam continued to face inflation pressures again, partly due to the 2008 global financial crisis, which caused inflation to skyrocket once more. This then led to further devaluations by the State Bank of Vietnam. If you've been listening closely for the past few minutes, you'd already see a pattern here, and that pattern is the State Bank of Vietnam. The SBV, for short, is the country's central bank, and this devaluation that they made isn't just a random occurrence. It's a deliberate monetary tool that they use. They were basically devaluing the currency on purpose. Whenever they did, it was done to achieve specific economic goals, primarily controlling inflation, maintaining export competitiveness, and stabilizing economic growth. After all, most of the times the dong was devalued was during the economic crisis, which, as we mentioned earlier, during the Doi Moi era, then the Asian financial crisis, and then the global financial crisis. Today, the dong continues to slide in value. In fact, the Vietnamese dong is known as one of the lowest valued currencies in the world in nominal terms. There are several factors that are keeping the Vietnamese dong weak, and that is the role of the government, which we just mentioned. One of these tools that they apply is the monetary policy framework. The SBV manages the exchange rate with a crawling band, allowing the dong to weaken modestly over time. When the dong faces pressure, authorities often intervene by selling foreign exchange reserves or adjusting policy rates. For example, as U.S. Federal Reserve interest rate hikes in 2022 strengthened the dollar, SBV initially spent billions from its reserves to defend the dong. This is one of the reasons why Vietnam's foreign reserves are so low. As a matter of fact, it's actually one of the lowest in all of Southeast Asia. You can see that from the total reserves in months of imports, which shows that Vietnam only has 3 months of imports, which is insanely low as compared to any other Southeast Asian economy. But there are times when the SBV can't really defend the dong's value, because the SBV doesn't have enough money or reserves. This forces them to step back and let the dong depreciate rather than face financial risks. In other words, Vietnam's central bank deliberately allows a weaker currency to conserve its reserves when under external pressure. Secondly, Vietnam faces a lot of trade and investment flows. These also influence the dong's value. Vietnam typically runs a large trade surplus with key partners, especially the US, which would normally strengthen its currency. But the SBV often buys up excess dollars from exports and foreign investment to prevent the dong from appreciating too much. This policy keeps the dong competitive. This is again, as we mentioned earlier, due to government intervention. This is a proven fact, as the US Treasury stated that Vietnam had heavily intervened in the currency markets, which in 2019, the dong was undervalued by 4.7%, due in part to government intervention. Then, we got to stop here and talk about why Vietnam's dong weakening is okay, and it is related to this trade and investment flows, and a reason why the government intervenes. This continued weak dong has actually been very good to Vietnam's economy because they are an export-oriented economy. A cheaper dong, after all, makes Vietnamese goods more affordable on international markets, effectively boosting the price competitiveness of everything produced in Vietnam, from textiles and garments to electronics and agricultural products. This has contributed to Vietnam's extraordinary export growth over the past few decades. This is why, if we were to graph out the world's largest export markets by country, we get to see that Vietnam, despite still being one of the smallest economies out there, has exports much larger than Saudi Arabia, Turkey, Thailand, Sweden, Indonesia, and a long list of economies that are much more prosperous, GDP per capita, and have a larger economy, nominal GDP, than that of Vietnam. This is partly because of the weak dong. This is the biggest reason why the dong's devaluation is actually okay, as it has helped Vietnam to become one of the world's biggest exporters, and to be a destination for foreign investments. If we were to graph out US imports by country, we get to see that Vietnam is ranked the 6th, even surpassing South Korea, India, and the United Kingdom. This substantial export is indeed related to the weak dong. The weak dong has effectively made US-bound shipments of Vietnam to be equal to about 30% of Vietnam's entire GDP. Such statistics are virtually unheard of among other US trade partners. For comparison, China's exports to the US are only around 2.5% of its GDP. The weak dong, by keeping Vietnamese goods cheap, has fueled demand in foreign markets. American, European, and regional importers have come to rely on low-cost Vietnamese products, from footwear to smartphones. Now, there are, of course, trade-offs and risks to this strategy. There are trade-offs related to higher import costs, risks related to being dependent on external markets. But the problems that a weaker dong would bring to Vietnam is for another video. For now, it's all about the positive impacts. But anyway, do let us know what you think. Thanks for watching.